Thank you for joining today's webinar on the decade after the deception. Are we destined to repeat the 2008 financial crisis? My name is Hank Kim, and I'm NCPERS Executive Director. Today's program is part of our Center for Online Learning, which provides remote continuing education to public pension trustees, staff, and other fiduciaries and stakeholders. Today, we're joined by Hannah Ross and Maya Saxena, and this session is moderated by our good friend Bob Klausner, and they will explore what has gone well and what has not gone so well over the last 10 years. So with that brief introduction, let me turn it over to the experts. Bob, let me turn it over to you to introduce your panel.
Thank you, Hank, and welcome to all. We're glad to be able to have this opportunity to present to you today. And I've been NCPERS General Counsel for over 30 years and a longtime friend and working colleague of Hank and our entire executive board. And we remain committed to quality trustee education because an educated trustee is the best fiduciary that there is. And I'm happy to introduce really two of America's top securities litigators, Hannah Ross and Maya Saxena, who I've had the pleasure of working with and currently working with on a number of cases on behalf of public plans around the country. And what we've done is to highlight some of the issues that we think are important in the coming decade as we get past the Great Recession and the market meltdown, and try to give you a crystal ball as to what the future looks like based on what has happened since that time. So I'd like to turn it over to Maya to begin.
Sure, and thanks, Bob, for that very lovely introduction as usual. So what we're talking about today are some of the financial cases that arose out of the 2008 crisis, with really a focus on how can we as shareholders and counsel advising shareholders prevent this type of thing from happening again. So I know that we're all kind of getting excited about being maybe at the light of the end of the tunnel with the pandemic and other things. So I hate to bring up recent tragedies, but 2008 was a pretty rough time. The 2008 financial crisis really wreaked havoc on the American economy. And just some of the statistics here are pretty shocking. We really saw another Great Recession where we had a massive GDP contraction. We had declines in the stock market by 54%, trillions of market cap completely wiped out. And I think I read a very disturbing statistic that about $3.5 trillion was lost by public pension funds, who really happen to be the biggest owners of the public equities. So we don't want this to happen again. A really good movie I saw recently, which I recommend, it's a movie called Dark Waters. It had Mark Ruffalo in it, who's one of my favorites. And there was a quote in that movie, and the movie was about the impact of all these forever chemicals and these PFAS chemicals that made their way into the water and killed cows and just polluted vast areas of land. And one of the lawyers there that was bringing the case against DuPont said, American companies are better than this and can do better than this. And when they don't, it's up to us to hold them accountable. And that really resonated with me. So let's start the presentation with looking at what happened in the past. And I think this slide is particularly telling because you're talking about real pillars of Wall Street that completely collapsed. And sure, a lot of them kind of got wrapped up into circumstances and the whole subprime crisis. But in many situations, you have conduct that really was attributable to them and really brought about their own downfalls. I mean, look at Lehman Brothers. One of the accounting gimmicks that Lehman Brothers was doing was they had this accounting gimmick called Repo 105. And normally they would do these repo transactions as a way of financing, that they would have they would technically raise cash by selling assets with a promise to buy them back later. So they would remain on the balance sheet because they were still on the balance sheet. So what they did with these Repo 105 tricks is that they technically sold these assets. They had to buy them back, but they took them off the balance sheet. So it made their balance sheet look like they were much less risky and into much less of a risky balance sheet. You know, Bear Stearns, this company had been around since 1923 and was one of the main companies involved in the whole subprime lending crisis. Their stock went from about $103 a share to less than $10 a share when they eventually got taken over by JP Morgan. So really, really catastrophic effects. So when we're talking about this whole situation, I think the important thing to remember is that this wasn't just a one-off circumstance. It wasn't a confluence of circumstances that resulted in these companies just getting caught up in a storm through no fault of their own. There are contributing underlying factors that can be seen as patterns over time in these types of companies. And what those failures are really failures in corporate governance. The boards of these companies that failed during 2008 and the subsequent years all have a lot of things in common. And here I've listed a few of the factors that have been studied after the 2008 crisis as having been contributing factors to all these meltdowns. And you do have several things in common. You have the quality of directors. You know, in these precipitating this collapse, you had directors of subprime lenders who served on a lot of different corporate boards. They weren't simply one company directors that spent a lot of time getting to know that particular corporation. They were spread thin. They got on these boards because of the prestige and the name and other factors, but they weren't truly committed to ensuring that those companies had quality systems in place. These companies also had boards that approved really, really risky policies. So these boards allowed companies to amass huge amounts of debt without really putting any systems in place to check what was happening. They weren't independent. So, you know, that could be anything. It could be that they all go to the same country club. Their daughters all go to school together. But you had a real lack of director independence during this time. And finally, what I think is one of the most important things, and that is poorly aligned compensation schemes. So you had companies during this time in a thriving market that really wanted to report very strong and rising quarterly results. So they prioritized short-term results over the long-term health and growth of the company, which resulted in very, very risky practices. So what did shareholders do about all of these horrible things that happened in 2008? Well, they actually did a lot. There was a tremendous amount of litigation that arose out of the 2008 financial crisis. And just an example of some of these cases, Wilmington Trust, the case that Hannah and I were involved in together, this company had all kinds of crazy practices. They would refuse to get current appraisals on commercial properties because they knew they would have to write them down. And they had tons and tons of very risky policies on their books, all the while telling the public that they had these very, very strict and stringent underwriting practices, which couldn't have been further from the truth. That case settled for $210 million. Bank of America, in connection with their acquisition of Merrill Lynch, multi-billion-dollar settlement. Lehman Brothers, we talked about. You know, these cases really taught us that one of the main lessons that we got out of the 2008 financial crisis is that we need to hold these financial institutions accountable for their actions when this type of thing happens.
Maya,
sure.
Oh, I'm sorry.
Oh, I was just going to mention one other thing, that when you talk about the importance of private securities litigation and private cases, during the same time the SEC did act, they got about $1 billion worth of recoveries for shareholders. But if you compare that to what the private sector did, and I commend all the public institutions out there for getting involved in these cases, because I would say the vast majority of these cases were led by public funds or institutional shareholders. Those recoveries that resulted out of the crisis were about 32 billion. So you can see right there with those numbers how important it is for these institutions to remain involved in these types of cases.
I wanted to comment on the effect of the market meltdown on our pension funds, those who are watching today. The reductions in accrued assets were the worst that had been seen by anyone in recent memory, and probably since the Great Depression. As a result, the greater concern was raised by those who are not friends of the defined benefit plans that make up a great majority of public pension funds, arguing that they and their plan sponsors may not be able to survive. What this did was give rise to a wave of benefit reductions. In fact, 49 of the 50 states engaged in pension reform, which is a euphemistic term if it's your pension that's being reduced, but it resulted in lower benefits to participants, including sometimes to retirees, and increased contributions from plan participants, many of whom faced wage reductions. To both of you, I'm asking, in these challenging times, please give me your thoughts on why shareholder activism became then more important than ever, and now why, with seeing record market highs, it remains equally important. Hannah, perhaps you could start.
Sure, and thank you, Bob. This is a really important point, and it really touches upon what Maya was just discussing. Public pension funds are major market participants. I think Maya just said the public pension funds are the largest owners of equities. And the pension fund community made a tremendous difference during the financial crisis. They recovered substantial sums of money lost due to misconduct, due to misconduct for injured investors. And this is really significant because of how the mortgage fraud worked. It was almost like a game of hot potatoes, because the banks that were originating the bad loans, they often sold the risk to investment banks to package those loans as mortgage-backed securities. And then those investment banks got the risk off their books and passed it to investors. So at the end of the day, a lot of the risk and then ultimately a lot of the losses really impacted investors. It hit investors hard. And it was the public pension funds who stepped up and helped recover those lost monies. And in addition to recovering monies back for investors at large, taking action in these cases also helped put assets and monies back in the pension funds themselves. So that was in the financial crisis. But now, today, such activism and engagement is as important as ever. It's as important during up markets as it is during down markets. I mean, what unfortunately we all know too well is fraud happens when the market's up or when the market's down. When the market's down, it's actually usually easier to identify that fraud. It's harder for the companies to cover it up and to conceal it. But when the market's up, it is harder to identify. And that's why public pension funds must remain as vigilant as ever to identify when fraud is occurring and to protect themselves and other investors and to take action when it's necessary to recover those monies.
And I think, Bob, going to your question about how to treat this type of case in an up market, I think it's a misconception that fraud doesn't happen when the market's good. Because in my experience, I would say that it probably happens more, because there's a tremendous amount of market pressure to sort of keep up with the Joneses. You know, your neighbor got a new Mercedes, you want a new Mercedes too. So there are companies who, when their industry competitors report very strong financial results, well, they want to report, you know, EPS of $5 a share for the quarter too. And there is a lot of pressure to kind of keep their stock price up and show that type of short-term performance. And we do see fraud in up markets and down markets. I think it was one of my other favorite movies, Greed is Good, right? It's always there when the stock market's up and when it's down.
I just wanted to add one thing. You know, you both made an observation regarding Lehman, and I think the funds here, all who were engaged in securities lending, everybody ended up with part of this pool of toxic assets, whether they wanted to or not. And I know it led to some serious friction between plans and their custodial banks over that issue. And so there isn't anyone, I think, in the public pension community who did not feel not just the pain of the declining market, but the after effects of the misconduct that led to the collapse of Lehman and left everyone stuck with commercial paper that probably was better off in the shredder than on the balance sheet. I think now, Hannah, you're going to continue?
A couple more, and then I turn it over. So this is just a reminder that when we don't learn from history, we're doomed to repeat it. And this next portion of our presentation is kind of focusing on some repeat offenders and these types of activities and conduct that unfortunately we see recurring time and time again. And one of the biggest repeat offenders, I would say, is Wells Fargo Bank. So starting in 2008, Wells Fargo was an offender, probably not an initial offender, because I know there were previous lawsuits, but Wells Fargo actually got in trouble as part of the credit crisis for what they did in terms of recognizing impaired loans, which resulted in a $125 million settlement. So they were certainly one of the key actors in the 2008 financial crisis. So unfortunately, they didn't learn in 2008, and 8 years later, we had a major scandal with Wells Fargo. And this many of you may have heard about because it was certainly front and center in the news, because there was a corporate culture of extreme demand for reporting increasing sales results. And even though certain markets where the bank was in could not possibly have enough people population-wise to increase the accounts the way that management wanted, those demands were still there. They were unreasonable demands and they couldn't be met, but they were strictly enforced. It was kind of like when Darth Vader, kills the guy, starts choking him in the control room. That's what happened if you didn't report your numbers. So Wells Fargo did all kinds of things. They engaged in what was called a cross-selling scheme. They were pretty creative in what they did. They would have people come in, older people sometimes, and have them sign change of address forms, and then they'd cut off the bottom of the account and paste it to a new account form. So they basically opened millions and millions of new accounts for people who didn't want the accounts, and in most instances didn't know they had them. So what happened was, as this slowly came to light, the various governments stopped working with them, pension funds divested of them, caused tremendous reputational damage to the company. And again, public funds kind of entered the fray to try to rectify the situation. You had two public municipal funds that got involved and brought what's called a shareholder derivative case. And that type of lawsuit is when the shareholders step into the shoes of the company and take action that the board of directors should have been taking already and try to rectify these practices. Instituted all kinds of reforms to try and strengthen the company and make sure that this didn't happen again. There was also an accompanying securities fraud case that Hannah's firm brought on behalf of an institutional plaintiff that had a sizable settlement, almost $500 million settlement in exchange for all of these practices and the harm to the company. So, of course, you would think that all these things that were put in place would have changed the company, reformed its practices, caused it to be on the upswing. And now I turn it over to Hannah to tell you why, unfortunately, that did not occur.
Thank you, Maya. And so just as Maya said, you would think that after the financial crisis, after the fake customer account scandal, that Wells Fargo would get its house in order. But that did not happen. I mean, just a few years later, Wells Fargo was implicated in additional frauds. And what's really shocking about the bank's just complete failure to reform and fix these issues is the fact that it didn't happen because no one was paying attention to what was going on with the bank. The bank's regulators were all over them because of this misconduct. For example, in 2016, after the fake account scandal, two of the bank's regulators fined them $135 million and imposed a consent order for the bank to improve its risk management controls. But it did not work, and the bank's controls got even worse. So this really goes to the question that Maya posed a little bit ago, which is how can we prevent this type of recidivist conduct for some of these banks? During the financial crisis, the refrain was, are the banks too big to fail? But here we are now, 13 years later, and we're still talking about some of these banks. So the question now seems to be, are the banks too big to reform? Are they too big to manage? Are they too big to regulate? And if so, what do the banks do next? As institutional investors who are invested in these banks, this is an important question because you are the ones who can achieve recoveries for the losses that this type of conduct causes innocent investors. And as shareholders, you can take action to try to affect change. So even if these banks engage in misconduct again, the public pension fund community is on the front line seeking financial recovery for the losses. As you probably guessed, the story here is Wells Fargo lies and repeatedly says that it fixed these problems when it really didn't. And this graphic, thanks to Maya and Bob, really does sum it up. Wells Fargo lies and lies to the public like Pinocchio. So this is what happens. In 2018, believe it or not, Wells Fargo gets caught up in problems again. The bank was charging hundreds of thousands of borrowers for unrequested auto protection insurance. In other words, they were charging their borrowers for auto insurance they did not purchase. And what's even worse is many of these borrowers defaulted, and some even had their cars repossessed. And this time, Wells Fargo's regulators said, enough. Enough is enough. The Federal Reserve stepped in and imposed another consent order. The Federal Reserve also took the unprecedented step of instituting an asset cap. And what this means is that the bank was prohibited from growing its assets by even a single dollar until it fixed the problems and reformed its conduct. The Federal Reserve made clear that it would not tolerate this type of pervasive and persistent conduct at any bank, and that they would make certain that such abuses do not happen again. Two other regulators also stepped in and fined Wells Fargo $1 billion and imposed their own consent order. So Wells Fargo had to comply with consent orders issued by three regulators: the Federal Reserve, the Office of the Comptroller of the Currency, and the Consumer Financial Protection Bureau. And just so you understand, these are the regulators for financial institutions. Wells Fargo should have been doing everything it possibly could to get into compliance. This was also of paramount importance to investors. Investors wanted to know how close the bank was to compliance so it could get the asset cap lifted and the bank could grow. So reforming and compliance was the issue. And while we know now from internal documents that the bank was not in compliance, and they were not even past the first stage of the program, that little yellow arrow on the slide, Wells Fargo and its executives lied about how far along they were. This slide highlights one of the bank's own documents that was produced in connection with an investigation done by Congress's House Financial Services Committee. The email shows that contrary to its public statements that the bank was in the first stage of compliance, the exact opposite was true. This email was sent by a longtime Wells Fargo board member to Betsy Duke, who was the chair of the Wells Fargo board. And the subject line was Fed response. Now, please keep this email in mind because this is going to come back up in a couple of minutes. But as the title implies, it was sent after the bank's regulators rejected Wells Fargo's proposed compliance plans, finding them insufficient and materially incomplete. This email makes clear that the Wells Fargo Board of Directors recognized that they were far from the beginnings of the stages of compliance. It states, instead, it seems that given the importance of clearing the consent order, we needed to nail this assignment. Instead, it looks like we totally biffed it. It also continues and says, I imagine that investors and customers would view this feedback as completely unacceptable. So let's take stock for just one moment as to where Wells Fargo is. They have 3 regulators who have imposed consent orders, a fine, and an unprecedented asset cap, and the bank is not in compliance. Board directors are aware of the problems, and still the bank is not in compliance. And it is with that backdrop that Wells Fargo goes to Congress. On March 12, 2019, then CEO Tim Sloan testified to Congress about the bank's progress in complying with the consent orders. As of that time, Wells Fargo was no further along in complying with these consent orders than they were when they were imposed 1 year earlier. But the CEO did not tell Congress the truth, even when he was specifically asked about it. Maxine Waters, chairperson of the House Financial Services Committee, asked him point blank whether the bank was in compliance. And his answer was, we are in compliance with those plans. Regulators, as you can imagine, were outraged at Wells Fargo and Sloan for lying to Congress. Sloan even called the Federal Reserve and apologized for what he said. And then a couple of weeks later, he resigned. But even with all the scrutiny from both its regulators and Congress, Wells Fargo did not issue a retraction. It did not issue an apology, and it did not tell investors the full truth. It did not tell investors why Sloan resigned. But the full truth was eventually revealed. On March 9th of 2020, a year after Mr. Sloan testified to Congress, the House Financial Services Committee published 2 100-page plus bombshell reports. In their reports, the House Financial Services Committee found that the former Wells CEO gave inaccurate and misleading testimony to Congress, that he downplayed the bank's deficiencies in statements to the press and to congressional questioners, and that he misrepresented the bank's progress toward lifting the asset cap in a series of public statements. Following the release of these reports, Congress had held 2 days of hearings of Wells Fargo executives. During those hearings, Wells Fargo's new CEO admitted that the reports were consistent with what he found when he joined the company, that we had not done what is necessary to be done. Then Betsy Duke, Wells Fargo's longtime director, who received the email we just discussed about how the bank totally biffed it, she resigned just days before she was supposed to testify to Congress. And during the congressional hearings, Congressman David Scott reprimanded Wells Fargo board members. He told them that the bank's actions in failing to respond to regulators was an unpardonable sin. And he accused the directors of not coming with the truth. And he concluded his statements with, "What a sorry excuse for a board." Chairman Waters sent a formal letter to the Department of Justice alerting the agency to Sloan's inaccurate and misleading testimony. And despite all of this, to date, the Department of Justice has not taken any public action against Tim Sloan. The Securities Exchange Commission has also not taken any public action against Tim Sloan or the bank. And as we all know from the financial crisis, individual executives are rarely held to account by the Department of Justice and the SEC. So I raise this question again. Are some of these banks too big to reform? One would have expected that after the losses and bailouts of the financial crisis, that more than a decade later, we would not have just experienced another major market disruption where significant wrongdoing occurred at the banks because of lack of oversight and lack of controls. And this is a critical issue given the size of these banks. They're massive, and almost every single public pension fund, almost all institutional investors are exposed to them in their portfolios. I mean, Wells Fargo lost billions of dollars. When the truth was revealed about the non-compliance with the consent order, the bank's stock price plunged and billions of dollars of shareholder value was wiped out. There is currently a securities class action led by the Employees Retirement System of Mississippi, the Employees Retirement System of Rhode Island, the Louisiana Sheriff's Pension and Release Fund, and Handelsbanken, which is a Swedish mutual fund management company. These funds are working and doing their best to return some of those losses back to all investors.
I think it's important that you mentioned that public pension funds are working together. And this thought arose to me as I was listening, Hannah and Maya, to your presentation. How have you been able to effectively engage multiple pension funds to collaborate in order to take on these huge financial institutions in the securities litigation forums?
Well, I think it's, everybody's on the same page here. Everybody wants to get their money back. Everybody's been defrauded, and they want to recover what they can for their plan participants. So I think, and I'm sure Hannah agrees, that it's often a really good idea to have public funds work together because they can communicate with one another, they can work with counsel, and if something happens, for example, when you get to the class certification stage of a case, there might be some issues that come up. There might be trading issues, or there might be reasons why one of the funds may not be able to continue. Well, you've got some backup. You've got the other ones there. And the combined and collective experience of these funds working together also gives us more leverage with defense counsel, with the courts. It's great to have Mississippi, but isn't it great to have Mississippi and New York? And, the more the merrier in some jurisdictions. There are some jurisdictions that don't prefer that type of combination. But for the most part, I think it can be a very effective way of handling these cases.
Yeah, I agree with what Maya just said. I mean, the partnership among public pension funds can create a very strong team with common interests and common goals, all for the benefit of injured shareholders. And especially when you're talking about financial institutions like these banks. I mean, many of these banks issue multiple types of securities. They might have debt securities, they might have preferred securities, as well as the common stock. So having a team of public pension funds in partnership out there trying to protect investors' interests, by joining together, they will cover all of the securities, and they will make sure that the recovery can be on all those multiple securities and multiple claims if necessary.
It's a great point.
And is Wells Fargo the only sinner, or are we going to learn about more?
We are unfortunately going to learn about more, Bob. So I think Hannah's last slide had an interesting quote that said, "What a sorry excuse for a board." Well, Unfortunately, I am going to be talking about a very sorry excuse for a board, and that is Citigroup. So I remember when I was a kid, it was Citibank, and they were kind of the iconic financial institution. It was like there was only one bank at the time, and that was Citibank. They had that really nice umbrella logo, and they were kind of all over the place. So what happened with Citigroup was that for decades and decades, they engaged in what I would call frenzied merger and acquisition activity. They bought hundreds and hundreds of smaller, mid-sized, all different-sized financial institutions and kind of tried to aggregate all of these institutions together in a way that sort of seems like Frankenstein's monster, that they had all these big different pieces, but the pieces weren't really working together. And that was the case for many, many years. Now, some of those shortfalls and failures to properly integrate all these various acquired entities came to light in 2008, because when the light shone on all these different amalgamations of companies that they had bought, they weren't able to withstand the stress of the credit crisis and wound up receiving, I think, about $500 million in a government bailout. That was in 2008. At that time, the regulators and the OCC came in and said, you guys are doing really, really badly with your internal controls. You aren't monitoring your financial transactions properly. You know, you're talking about an institution that gets trillions of dollars of financial flows through its system probably every day, and did not have the type of mechanisms, controls, practices, risk monitoring, anything in place to effectively monitor what they were doing. So they were warned pretty extensively. They were fined multiple times over the year, culminating in 2019, when you have a $400 million fine because of what is pretty extreme language for the OCC, which isn't the most exciting regulator, called their practices unsafe and unsound, which is pretty harsh criticism for a bank. They actually had such poor controls that they sent out nearly $1 billion vendor payment to a vendor that hadn't even sent them a bill, and it wasn't an accurate payment. I mean, I may have sent the wrong Venmo, $10 to people for pizza here and there, but $1 billion payment to the wrong vendor. So you have a bank that does not have the mechanisms in place, and you have a board, which, as Hannah pointed out with Wells Fargo, is a sorry excuse for board. Where was the board over all these decades? What were they doing when all the OCC notices came in? Why weren't they able to put the right procedures in place? There is a pending case right now that Rhode Island brought, which is seeking to essentially have a seat at the table and have the company correct these failings so that their investment going forward will strengthen, and that the company will have the proper types of controls going forward to prevent this type of thing from happening. And that's a really exciting type of case for a lot of the public funds, you know, particularly some of the municipal funds, because you don't have to have a huge amount of stock and you don't have to have a loss. You just have to own the particular stock for a certain amount of time, for a relevant period of time. If you do that and you bring one of these cases, you essentially have the ability to sit in the shoes of the company and try to fix and rectify what they themselves should have, which in turn really strengthens the financial controls, the governance of these companies, which results in greater financial returns. And I think, Hannah, you're up with another of our repeat offenders.
Before we get to the next of the rogues gallery here, I did have a question. I noted, or a comment, I noted that in both of your presentations, not only were billions of dollars of shareholder value being wiped out, but I see these companies are paying billions of dollars in fines. And aren't the shareholders themselves actually suffering the loss because the company's taking their money for the companies that they own and using it to pay the fines that the officers and directors are supposed to be working for us as shareholders cost the companies.
So, and Maya, jump in if you want. So when it comes to some of the fines that some of these banks are paying, that is something that will be part of the derivative action, that the wrongdoing that the company and the lack of oversight and the lack of controls that put the company in this position, that is an example of the harm, or one of the types of the harms that hurt the company. And so the funds who take action and bring a derivative case include that as part of the wrongdoing at the company and do that as part of what they want to recover to help the company improve.
Yeah, that's exactly right, Hannah. And I think one of the powerful tools that shareholders have in these types of cases is you hit them where it hurts. If there is a particular defendant in one of these companies who is one of the largest wrongdoers, well, they need to contribute. They need to put some of their own money that they gained as part of these compensation schemes when they recognized multi-million-dollar bonuses over this period of time. They need to return that money to the corporation. If that was wrongly earned during these times of wrongdoing, well, part of these types of actions is often getting that money back or some portion of that money back.
And have you been successful? I believe you've both been successful in cases that you've brought of including recovery of these fines within the total recovery within the cases. Am I right? Am I correct? You
are absolutely correct.
And Hannah, I think you're going to tell us about what's in your wallet.
Exactly. Thank you, Bob. So Capital One is another example of a financial institution that did not fix its failings after clear warnings by its regulators. So Capital One's failings had to do with violations of the Bank Secrecy Act, the law that governs anti-money laundering. The truth came out this past January when the Financial Crimes Enforcement Network, which is called FinCEN, announced that it had imposed a $390 million fine on the bank for willfully and negligently failing to implement and maintain effective money laundering controls. So FinCEN, in case you are not familiar with this group, it is a bureau within the Treasury Department that analyzes financial transactions to combat money laundering and other types of financial harms that threaten our financial system. So Capital One is a really interesting example because unlike Wells Fargo and Citi, by the time these revelations were revealed, and came out to the market, the stock price did not decline. There was no stock price decline like there was that we just talked about in connection with the Wells Fargo case. And in connection with the Citigroup case, there was also a securities action because the stock price declined there. And this is true about several banks that FinCEN was investigating for money laundering, that the news came out, but there wasn't that financial immediate harm to the stock drop. But this nevertheless highlights some of the concerns we've been talking about this repeat behavior and how to prevent these banks from repeating history. So here, FinCEN's actions came after repeated actions by the bank's regulator for failures in its anti-money laundering program, including a $100 million fine for not complying with a prior consent order. And these violations all occurred in Capital One's check cashing business, which has since closed, but it was the subject of investigations by FinCEN, by the Department of Justice, and other regulators. Ultimately, FinCEN found, and Capital One admitted, and that's really important, Capital One admitted to this wrongdoing. It admitted that it had inadequate anti-money laundering policies and procedures. And this is really important with respect to the Bank Secrecy Act, because the Bank Secrecy Act requires financial institutions to assist law enforcement in detecting and preventing money laundering. And Capital One failed to do this on an enormous scale. It failed to file currency transaction reports, and which all of you probably know, if you transact out at a bank in an amount that's greater than $10,000, that bank is supposed to report it. And the bank is supposed to file a currency transaction report upon that transaction. But Capital One said it failed to file such reports for 50,000 transactions that totaled more than $16 billion in cash. It also failed to file suspicious activity reports, even after it learned in 2013 of potential criminal conduct by potential customers. And as you can see right here, the individual that has a red circle around his head, this was a primary customer of Capital One's check cashing business. And it came out that he was associated with organized crime, and he was actually sentenced in 2019 to 10 years in prison after pleading guilty to conspiring to launder money in schemes that funneled illegal loan sharking and gambling proceeds through his Capital One accounts. The bank allowed this customer to make more than 20,000 transactions worth roughly $160 million through 23 different accounts, even after it learned of potential criminal conduct by him. So these were egregious failures that came after prior warnings, after consent orders, and after fines. So thankfully, as we've gone through these three banks of repeat misconduct, Wells Fargo, Citi, and Capital One, thankfully, we have public pension funds like you doing everything you can to help investors recover losses, to help make sure that these companies and these financial institutions reform their practice, and to help protect shareholders.
You know, it appears that in looking at that rogues gallery that you had, which kind of, if it weren't real, no one would believe it if you made it up, that, you know, it's like Wall Street meets The Sopranos. But it occurs to me that with all of the billions that were of dollars worth of misconduct, one guy gets 10 years, and yet he's obviously the low-hanging fruit, and the guys in the suits who sent him there suffered no consequences at all, at least in the criminal justice system. I mean, were it not for pension funds and other institutional investors seeking the remedies civilly, what would protect shareholders from the types of multi-billion-dollar losses and misconduct and flouting of federal securities laws that your presentation observed?
It's a very good point, Bob, and that's kind of been the case, I would say, through history. I mean, even if you go back to some of the major frauds like Enron and WorldCom and even Wilmington, the amount of criminal convictions in these types of cases is really, really slim. And if you couple that with the Securities and Exchange Commission's enforcement actions, I remember seeing a slide several years ago about the discrepancy between private actions and the SEC actions. The settlements that public funds and institutional investors have been able to obtain in the private arena really dwarfs what the SEC has gotten back. So, you know, unfortunately, when it comes to this type of wrongdoer, criminal fines and criminal sentences are probably pretty unusual. But we know that financial culpability and financial returns from these people is really significant. And, you know, that's what we're left with, and that's where our clients come in.
Hannah, did you have a comment?
No, I think that was very well said, Maya. I mean, I think that our public pension fund clients, you know, everyone who's participating on this Global Meet webinar today, I mean, the actions that you take to protect the financial markets and the actions that you take to really make the executives fix these companies are important, and they benefit all investors throughout the country. And obviously they improve your funds and help return assets back to your funds.
Over time, changes in administrations will bring different philosophies to the financial enforcement network. And although it's not necessarily about securities fraud specifically, the Labor Department at the end of 2020 had issued two rules. One was about proxies, essentially saying that ERISA regulated plans, and of course public plans are not ERISA regulated, but private sector pension plans in voting their proxies could not look at anything other than money. In other words, shareholder initiatives like Say on Pay or this type of misconduct that we've described today would not be a proper exercise of fiduciary responsibility to consider in voting a proxy. The other rule had to do with environmental, social, and governance initiatives, or ESG as the acronym is, which the Labor Department's rule also said that when you're making decisions about when an institutional investor regulated by ERISA was making an investment decision, it should not consider environmental, social, or governance issues unless it bore directly on finances. In other words, if it was going to make me money, great, include it. If it's not going to make you money, don't be concerned about it. And I was curious if in your experience, you found that the use of proxies and the use of ESG has actually worked to eliminate fraud or correct fraud and ultimately benefit the shareholder.
So I think that the whole ESG area is going to enjoy renewed focus with this administration. I think the public fund community is very interested in investing in companies for ESG reasons. But I think for years, what companies have to disclose about ESG has been kind of flimsy. So I think that there are some leaders in this area like BlackRock and others that are now reporting their ESG factors in accordance with the Task Force on Climate-Related Disclosures, which basically says, how does climate change impact their company, and how does their business fit in with kind of this new world order where things are going to look very different? And I think those types of disclosures are very important. And I would say, that we three on this call kind of know about this type of issue firsthand, because one of our cases in the Rayonier case was a timber company that had been over harvesting trees for years, and finally, had to reckon with the practice of over harvesting on their financials. One of the key issues there was the meaning of sustainability. Defendants said, oh, that's just a marketing term. It doesn't really mean anything. And our court actually said, no, that's a very significant term. So I think that you'll see terms like that take on greater significance kind of in this new administration and new economic climate.
That is totally correct. And that really is coinciding with a greater focus by institutional investors on these principles. Institutional investors have become increasingly more focused on ESG issues and principles. So those two factors coupled together, I think, definitely indicate that this is something that we will be hearing more about and seeing more about in the months and years to come.
As we're closing in on the end of our program, what we want to do is invite your questions. And I would also invite Hannah and Maya to have a closing comment. My brief closing comment is this, that it appears that you can't rely on the arms of government that regulate the financial markets to be our champions in terms of preserving the assets of our retirement systems, and that it requires the type of dedication and shareholder activism that so many public plans that we all have the privilege of working with have shown over the years, and that have recovered so many billions of dollars into the coffers of those pension funds, and really the taxpayers of the need to replace that money that was lost due to corporate misconduct. So I think this is, in my view, an important exercise of fiduciary responsibility. So Maya and Hannah, whoever would like to go first, I'd invite your closing comment.
Go ahead, Hannah.
All right. Well, Bob, I think you really captured my sentiments very well. It's the work that public pension funds and the public pension fund community has done, certainly in the cases we talked about from the financial crisis and over the past 13 years, have been so important and meaningful to returning monies lost due to misconduct. And as we've just discussed, public pension funds need to take action to protect their assets going forward. It's clear that these companies are in many respects too big to regulate and too big to reform. So we need institutional investors to step in and to make sure that investors are protected.
Thank you. I'm seeing, Hank, that we do have at least one question. If you could read it for the benefit of the audience.
Sure. The discussion was interesting. Are there cases where managers that do not have the backing of a bank illustrate ways to avoid knowledge of accountability and risk?
Who'd like to take that one? I think if I could just comment briefly while you're considering your answers, all these cases, that we happen to be talking about bank-centric cases today. Often banks aren't the ultimate sinner. That we've had cases where companies have tried to move overseas to save taxes and ended up getting hit with bigger taxes in Europe that they would have if they'd have stayed in the United States, and then try to cover it up. I think the underlying theme in all of this is about enforcing truth in the marketplace. And so our managers that manage our portfolios, because virtually every public pension fund has fully discretionary managers, get taken in by the lies in the same way that we do. And I would ask Hannah and Maya, if in their experience, what they've learned that managers should be looking at on behalf of our funds to help avoid the losses as they're occurring.
Well, go ahead, Hannah, if you wanted to.
No, I think that really what you just said, Bob, is really the critical issue when it comes to managers, because the managers are also being told the same misinformation. The facts are also being misrepresented to them. They're not being told the truth. So the managers are acting and doing everything that they can based on the information that they are being given. So it's really important to remember, though, that when these companies or these banks are lying to the public, they are also lying to your managers.
Yeah, that's exactly right. We're all on the same page with the managers. And what you see is multiple instances where even if a manager is doing extreme due diligence on the investments that it makes for the plans, they would not have been able to uncover this type of fraud, because you actually have executives that are lying both to the public and to managers. And I really can't think of many instances, if any, where managers were kind of brought into the fold and given secret tours of what was actually happening. So we are on the same page with the managers, and they are defrauded just the way that the public is.
Hank, back to you.
Thank you, Bob. And Maya and Hannah, thank you for this great presentation and wonderful discussion. Bob, thank you for running such a well-moderated session. I agree with the questioner. I thought this was a very interesting session. So thank you so much for giving us your time and your expertise today. And to everyone who's joined, please join us on April 6th for our next webcast entitled A Decisive Decade for Climate Change, Asset Management, a Catalyst or a Consequence.
And
everyone,
Hank, I'd like to thank you and your hardworking staff. What most people don't know is in the midst of the pandemic and the adverse impact that all of this has had on NCPERS, you all have stayed on the case and stayed on the job. And I know that you've all made personal financial sacrifices to continue this good work. And on behalf of all of our funds, we appreciate that.
Thank you, Bob. And thank you so much for the support from our corporate members as well as our fund members. We are here for your benefit. And, like everyone else, we've had to adjust and be nimble. And I take very little credit for that. I think staff has done a wonderful, wonderful job. And I know that, the same is, it's the same with your respective law firms as well. So thank you so much for this great presentation. And we look forward to seeing you hopefully at an in-person program sometime in 2021.
Thank
you, everyone.
Thank you so much.
Bye-bye.